Absolutely. There's a lot of misunderstanding about what goes into a credit score and how our buying and spending and payment habits really affect that and what that really means to us in life. So we have some great information. Let's go ahead and move into the presentation here on credit scoring and talk about what we have.
That'd be great. Today we're going to talk about the facts and maybe what you can do to improve your score, what goes into a score, and let's get right to it.
By the way, we have a lot of information, so we're gonna really move through this because there's some great meat. We don't want to leave any parts of it out, and we have some great giveaways and bonus information for you as well. So why don't we run right through what's on the screen here?
Yeah, this is a question that we get all the time is what does the score mean? They look at this number, okay, and they say, well, they pulled this out of thin air. How did they get it? And actually, the number means that they're measuring the statistical chance of a consumer becoming 90 days late on a particular loan over 24 months.
Okay.
Okay, and then the way that the credit bureaus do that is they'll generate and look at thousands and thousands of credit reports over a 2-year period, and then they measure all those, and that's how they get that analysis that they use to actually create your score. And then there is 4 credit bureaus, not 3, but Innovis is really the 4th bureau, but they're never counted. They don't actually create a score or anything.
Okay, so if you look at this, what are the odds of going 90 days late? This is very interesting. Break down these numbers and tell us exactly what they mean.
Yeah, well, what we're finding is that the average credit score out there, I think right now, from the information I got just a month or so ago, is about the average score is a 720, so half the population's above and half the population's below. But the odds of you going 90 days late, if you got a 620 score or less, is 15 to 1. 620 to 679, 47 to 1. 680 to 719, 112, and it goes all the way up to 800 plus. Of course, your odds at 800 plus scores are very low.
Right, so just to make it real simple here, if someone has a 620 or less credit score, there's one chance in 15 that they'll go 90 days late on something. But if they have a credit score that's over 800, there's only one chance in 1,485 that they'll go 90 days late. So those are pretty good odds. Okay, we mentioned it. We have some great information here. And one of the things I think people don't really think about is what bad credit costs them. And so there's a great report that we'd like to provide to you that's called What Does My Credit Cost Me? And it actually shows you the effect that delinquent or derogatory credit can have on what you spend money on through your life and how much more expensive it is for you if you do have a lower credit score. If you'd like to get a copy of that, well, just go ahead and give us a call at the number that you see right down there at the bottom of your screen. Okay, very good. So let's come back into how the credit score is calculated. You got some points here for us.
Yeah, this is actually how the credit bureaus actually do this. They take 1,500,000 credit reports, as I mentioned before, monitor those for a 2-year period, and then they look for those 30, 60, 90-day lates, and that 90-day late that they're looking for, that's exactly how they calculate the algorithm that's used to calculate your score.
Very interesting. That's where the metric comes from.
Yeah, they form these scorecards, and there's actually, in the current FICO scoring model system, there's 10 scorecards. And then when they come out with the new FICO 08, whenever that comes out, they're talking about 12 to 14 more scorecards, and that's going to be totally different. But each scorecard has its own predictable variables by the credit bureau. So that's why each bureau has different scores. So you may have a different score from TransUnion versus Equifax and versus Experian.
Not only may you have a different score, but I think as you're going to point out here to us in just a few minutes, you absolutely will have a different score.
Very rarely will you ever see two the same.
Very good. Okay, so when we talk about different credit scoring models, break this down for us and help us understand what you're talking about.
Yeah, and a lot of people don't realize this. I mean, we deal with a lot of loan officers who are looking for mortgages, and the client may call you on the phone and say, well, I've got my score, and the first question we have to ask is, well, where did you get your credit report? So if you get online and pull a credit report and ask for a score, you're going to get what's called a consumer credit score. And those scores are typically 300 to 900. So that may be a score that's used to purchase furniture or consumer goods, maybe the $0 to $2,000 to $3,000 range. Now, if you pull an automobile and you want to go buy a car, those scores may be 250 to 900. Totally different credit scores. And if you want to pull a mortgage, then those scores are anywhere from 300 to 350 to 850.
Right.
And the reason these models are different is simply because the risk factor is different for the creditor.
Okay.
So the creditor's got a lot more risk on a 30-year mortgage with a $100,000, $150,000 loan versus a consumer that's buying a chair for $800.
Okay, very good. All right, now they break these down into reason codes.
Yeah, the reason codes are listed typically right at the top of a credit report. If you pull one, there's 26 reason codes, and they'll list the top 4. And this is what may be negatively affecting your score. So you want to look at those top 4 codes that show up on your credit report. If you have a low score, you're going to say, well, why is my score low? The first thing that I look at on the bureau then is the reason codes, and they will say brand new delinquency or public record filed recently. And I can go right down to the public records section of a credit report and see that maybe a tax lien showed up or there was a judgment or a car repossession or something like that. So that's why you kind of look at those reason codes. And that kind of guides you to why maybe the different areas of your credit bureau that are affecting your score negatively.
I like the points you have here. There's ranked from the top reason to the bottom. Why did the consumer score less than 850? But your point here at the bottom is you've never seen an 850 credit score.
That's right.
So everybody's going to have a reason why they're less than 850.
That's right. All right, well, we've got another great report for you. It's called the Purge Report, and a lot of people say, well, Jim, how can these errors happen on a credit report, and how do I know if I have any errors? And we've got a great report for you. It's called the Purge Report, which stands for the Public Information Research Group, and it was done in 2004, and they actually did a study and just pulled randomly people's credit reports and found that 70% of the credit reports had errors on them. 70%.
So really, two out of 3 people walking around out there have some sort of an error on their credit report.
That's right, and we'd like to share that report with you today. If you're on the call and you'd like to get that, just call the phone number right below the presentation, and we'll get that report right out to you.
Okay, very good. All right, so let's talk about just for a minute, what makes up the credit report. I mean, certain things weigh heavier than others when they're developing the report. So let's talk about those items now.
Yeah, and this is very good information to have, but 35% of your credit score is based on delinquency. So some people may say, well, you know, I had a 30-day late. Well, a 30-day late can affect your score anywhere from 20 points up to 100 points.
Wow.
So even one little 30-day late, yeah, and the range is so big because let's say you have an 800 score and you get a 30-day late, it might hit your score at 100 to 120 points. If you have a 550 score and you get a 30-day late, it may only hit your points like 20.
Yeah, I think, though, if you have a 550 score and you get a 30-day late, odds are that's not the only 30-day late on the report.
That's correct. Now, the second largest factor is the revolving debt ratio. And people always say, well, what is this utilization ratio? What's this debt ratio? And basically what it is if you have a credit card that you got approved for, and let's say it was approved for a $2,000 balance, so that's your upper limit, and you have a $500 balance. So you have a 25% ratio of your open line of credit to what you've used, okay? $500 compared to $2,000, so 25%. So you've got a 75% utilization ratio that's open credit. That's 30% of your score. So that's a pretty large component, and people really need to watch their balances. There's another way to raise your scores is to just pay down your balances on any open trade lines.
So if you have open trade lines that don't have any balance, that's beneficial for your score.
Yes, it is, and that's a very good point too. If you have some of those trade lines that you haven't used, they're recommending now every 6 months to use those credit cards. The companies will close them. That's just started to happen in the last 6 months.
Okay, so if you have one that's been sitting for a long time and you want to keep it, you'd be well advised to take and make some small purchase on it, then turn around and pay it off.
That's correct.
All right, so next we see the average age of a credit file. Explain how this comes into play.
Yeah, this is 15% of a credit score, and you don't need to worry so much about the positive items on a credit report. They will stay on your credit report ad infinitum, so they'll be on there forever. But the age of those, so let's say you've got a credit card that you've only had for a year, but you've got another credit card that you've had for 5 years, and you decide to close one of them. And we don't recommend that, but if you did, you would definitely want to close the one that you've had the shortest period of time. So, but that comes in, it's about 15% of your credit score.
Okay, so let's put this in layman's English here. I have 2 different credit card accounts. Each one has whatever, a $3,000 balance or a $5,000 balance, but one of those accounts is a year old and one is 5 years old. If for whatever reason I wanted to get rid of one of them, in terms of my credit score, the 5-year-old account is worth more to my credit score than the 1-year-old.
That is correct.
Okay, that's a very interesting piece of information. Okay, mix of credit. Talk about this.
Yeah, the mix of credit is 10% of your score, and we got another slide on this later, so I won't spend a lot of time on the mix of credit. But just know that revolving installment, mortgages, automobiles, we got another slide we're going to show you, but it's about 10% of your score.
Okay, then the last component of what makes up the credit score is inquiries, and tell us how that affects the score.
Yeah, inquiries are about 10% of a score, and if you don't know what an inquiry is let's say you want to go out and buy an automobile. They'll actually be pulling your credit at the dealership typically and looking for those loans for you. And every time that is called an inquiry, it's a hard hit on your credit report, and that's called an inquiry. Typically 2 or 3 inquiries are okay, is what the credit bureaus look for. You get over that, and then it'll start hitting your score. But it's about 10% of your score, so you want to keep those down if you can.
Okay, so certain types of inquiries are detrimental to your credit score, and as we're going to find out here in a few minutes, there are some inquiries that are not detrimental and that you can find out about your score without causing the actual score itself to drop.
That is correct. That's a great tip.
All right, good. We'll come back to that in just a little bit here. All right, so just to kind of review here, the credit scoring components, this is fascinating in terms of how all this stuff stacks up because, frankly, I didn't completely understand this. So the first part, we had past delinquencies, we had debt ratio, we had the age of the file, which I thought was a key component that most people absolutely don't understand, the mix of credit, the types of credit that you have, and then the inquiries. And when you look at them all together like this, a couple things jump out here that are worth paying attention to.
Yeah, I think the biggest thing that we try and discuss with people when they're looking at their credit report is those first 2 items are 65% of your score.
Yeah.
So if you're going to get on there and you really want to work on your credit or maybe get your score up, you need to keep those past delinquencies down, those 30, 60, 90-day lates, and the more they age, the higher your score will go.
Yes.
And you really want to pay down the balances on those credit cards or those debts that you have, and you'll see your scores come up.
And, you know, really, when you look at it graphically like this, it helps to bring things into focus, but as you explain that, really, I mean, it's only common sense. If you talk, well, let's see, how do I build my credit score? Well, cut down on my delinquencies. Okay, well, that means you pay your bills on time, right? And,
correct.
And also pay them down. Okay, so now you don't have stuff that you're paying on, and the stuff that you do have is being paid on time. Okay, so good. That's a great summary of the credit scoring components. Now, I was looking forward to this, and I have to confess, when I took this test, I didn't exactly score 100% on this. So let's go through this kind of one at a time. We'll take a look at this. So, okay, closing my used credit cards will improve my FICO score. I absolutely would have checked true on this, but the real answer here is false.
Yeah, the unused credit cards, if you guys close those, as we showed on the slide previously, what you're doing is you're decreasing your debt utilization ratio. So let's say the card had a $5,000 upper credit limit. You just took that away, and you took away the history, which is 10% of your score. So you automatically took 2 components of the scoring model right out of your algorithm.
Right. So in the same way that delinquencies are good not to have, history is good to have. So when you close those up, it's like ripping up and throwing away the good stuff I've done. You don't have that anymore, and now they don't have that to look at.
That's exactly right.
Okay, the next question. My FICO credit score should be the same on all 3 bureaus. Okay, well, I did know that one. That answer's false. And you spoke about the reasons for that just a little bit ago, because they all use different models.
Yeah, exactly. They all have their own little models.
Okay. When I get married, my credit report is merged with my spouse's. Well, see, actually in our house, that's been kind of a little point of fun because, you know, we'll kind of go back and forth when we, you know, the different times we've bought properties and whatever, we've taken a mortgage out for that. So it's always fun. We kind of get a little one-upsmanship, my wife and I, on who's got the better credit score. But because of that, I know that this question here, that would be a false. That would be a false answer.
That is correct. A lot of people don't know that, but Yeah, the only thing that you're going to be reported on is what you've signed on as far as a note with any creditor.
Okay. And then checking my own credit score will create an inquiry at the credit bureau, and that will lower my score. Well, as we just spoke, you mentioned that you don't want these hard inquiries because too many of those can lower your score, but that's not always true, and because of that, this answer is false. Can you go ahead and explain why this would be false?
Yeah, a lot of people don't realize there's what's called a hard inquiry and a soft inquiry. So if you go out and apply for a mortgage or a car or a furniture loan, the creditor will pull your bureaus, and that's what's called a hard inquiry. Now, those will probably hit your score. The last we knew, about 2.87 points per inquiry that you make, up to a 10 or so, and then an algorithm kicks in and it goes down. But there are hard inquiries and soft inquiries. Now, if you get online and you go to one of the thousands of companies that are online saying, get your free credit report, those are typically soft inquiries, and you are eligible to get a copy of your credit report free every year. We're going to talk about that in a minute. But those are soft inquiries, and those don't hurt your credit score.
Okay, very interesting and good to know. I've actually resisted going and doing those because I didn't want to drive down my score. So now I know that won't affect me the way that I thought it would. And the last one that we have here, my annual household income is part of the calculation of my FICO score. I would have said that was true, but again, as we come through here, we find out, nope, that's false.
Yeah, all those things that we saw in the pie chart earlier, that is all that's used to calculate your scores. It has nothing to do with your income.
See, I would have thought at least that in figuring what your debt ratio is, it's like your debt-to-income ratio, but it's really not the debt-to-income ratio. That's not how they look at it.
That's exactly right.
Okay. Very good. Well, look, there's just tons of sites out there that will give you a credit report, but there's only one of them out there that's monitored by the FTC where you can get a free credit report each year, and we'd like to give that to you. So if you'd like to find that website, just give us a call at the number right at the bottom of the screen, and we'll be very happy to share that with you. Again, that's for the only site that the FTC monitors where you can go each year and get a free credit report. Okay, now here's something that's fun, and this is made even more fun. Somehow the lottery's more fun when you don't win, even if you know somebody who did.
That's right.
Right? So
That's
we got a buddy, Pat, who actually went to this site, and darned if he didn't find $600 that belonged to him. And talk a little about this. Tell us what it is.
Hey, this is just a free fun tip that we'd like to throw in here. It's called missingmoney.com, and there's some of these sites out there, and they'll try and get you onto the site, and they charge you then. They'll say, well, you might have some money out here, but we're going to charge you to do it. But this one's actually free, and this is just a fun site. But just jump on this site, www.missingmoney.com, and put your name in and the state that you live in. I even checked my parents. My father's deceased. I checked his account. There could be insurance policies out there, all different kinds of securities information that could have been from a 401k.
Yeah.
They could be sitting out there with your name on it or a relative's name, and this thing will do the search for you. And if there's money there, you can claim it, and Ralph, they send it to you. This is great.
Okay. Yeah. Before we go to the next slide, hold on. I got to write this one down. Missingmoney.com. Okay, so that's a fun tip, and you want to write that site down and swing by and see if there's anything waiting for you. That'd be great. Okay, so coming back to the conversation about the credit scores, talk for just a minute here. I mean, does everybody have a credit score? What do you have to have in order to have a credit score?
Yeah, and if you've got young kids coming up and they're just establishing credit, they may not have a score. And here's the other side of the coin. I've seen retired people who have paid all their debts. Their houses are paid, their cars are paid, and they're paying cash for everything.
Yeah.
They will not have a score.
Okay.
And the reason is, unless you have an account that's 6 months older, not reporting, then your score will actually go to 0, and it says NA on your credit report.
Okay.
So you may have a history of excellent credit, but if you don't have anything reporting on there, then your score is going to go to NA. So, you definitely want to have something on there once in a while. Get that credit card out and use it. Go buy gas or groceries or something with it and pay it off, and your score will just pop right up. And the other thing I'll point out is that your credit score is actually like a snapshot in time. And so think of it as you took a camera and took
Yep.
a picture of the moment in time. So if you take a picture and you can change the picture, then you can change your score. And it's that easy, basically. You get one item reporting on that credit. All that history from 20 or 30 years worth of paying on time comes into the snapshot. The
Yes.
algorithm kicks in, and boom, you got a score just like that.
And, you know, really that sort of gives hope to somebody who's out there who maybe has been through a difficult time. Having reviewed credit scores for years, you could look at someone's credit score and tell when they had some significant life event. You find somebody that had paid things perfectly for a period of years, and all of a sudden, bang, everything went right down the garbage. And then when speaking to them, you find out, well, my spouse became sick, my child became sick, I went through a divorce, I got laid off, our company went bankrupt. Whatever the thing was, you can tell, and here's these glaring trails that are left on someone's credit report that give really big clues about what's been going on in their life. So if that's happened to you, I guess the point that Jim is making here is that that's not the end of it. That's just a snapshot, and you can change what that is now into what you would like it to be in the future. The third point down there, though, you do have to be alive to do that. Okay?
That is correct.
Okay, very good. By the way, I heard an interesting statistic at one time. I had a company tell me that a person who has no credit score, this company applied a score of 555 because as models were at that time, and it was in real estate, a person with no credit score behaved in payments, in making payments, most closely like a person with a 555 credit score.
Oh, that's interesting.
Yeah, isn't that something? Okay, so let's give you got some tips here that are very helpful. Let's run through these real quick.
All right. Revolving accounts and installment accounts. So if you have a credit card, that could be a revolving account. If you have a car payment or something like that, that's an installment. The revolving accounts are weighted heavier, so you want to make sure you have a nice balance of revolving and installment accounts on your credit report.
Hey, would an exception to that be mortgages? Because the reason I'm asking that question is because, maybe it was only because it was mortgage companies that were looking at it, but if they looked at a credit report and, mortgage lates were graded more harshly than virtually any other kind of late on the credit report. Is that only because it was a mortgage company?
Yeah, if you have a mortgage late, typically those are weighted a little bit heavier just as the scoring model is because that's a longer term debt and a bigger debt. So the creditor is at a higher risk, and that's usually the biggest thing that you've got on any credit report is a mortgage.
Okay, but as a general rule, revolving accounts are weighted more heavily than installment accounts.
Correct.
Okay, good. So
yeah, we're going to talk about we've got another slide that we're going to talk about the mix of mortgages, cars, credit cards, and all that.
Okay. This next point here is very interesting. Go ahead on that one.
Yeah, we've got a new problem that's just cropping up right now. As you pay off your credit cards, the banks, because of the new credit card laws that were just passed in February, we're seeing the banks now closing either the limits of your cards or closing the cards altogether. So we've had numerous people calling our offices saying, I had a $25,000 limit on my card. I've had it for 10 years, and I only have a $2,000 balance, and they're chopping their upper limit down to $5,000. And as we showed in that pie chart, that's 30% of your score, that utilization ratio.
Yeah.
So we had a couple people, their scores dropped 50, 60 points, and there's not a lot you can do right now with that. That's totally up to the creditor's discretion to do that. So that's a problem right now that's showing up with some of our clients.
Now, you know what, though, in all fairness to the banks, they've really been taking a beating over their previous lending practices, and frankly are being blamed for much of the situation that's going on right now in the credit markets where people are overextended because credit's been so easy to get. So this is something to be aware of.
Yeah, and remember, these are all tips for you guys to get your scores up. But just be aware that some of the credit card companies are doing this. The next tip is just pay those balances down to close to zero as possible, so that they're still open and active, but you maximize that utilization ratio. So that's key. And then the last one is if you're trying to get something to report as soon as possible. So let's say we've had a lot of requests lately for people renewing their credit. They need a secured credit card.
Yeah.
As soon as you get the card, go out and use it that day or the next day, buy gas or groceries with it, and then send your payment in. Come home, you know how much you spent, write a check, mail it out that day so it reports as soon as it can. And as soon as you get those first trade lines reporting, the sooner you get that reporting, the sooner your score will pop up.
Very good. So you're not waiting for the statement to come in before you send your payment out. You're being proactive with it.
Yeah.
Okay. So we got some more scoring tips here.
Yep. A few more tips for everybody. Spreading those balances out in the new scoring models won't have the same effect. Now, keep in mind that the FICO 08 is not in effect, so don't worry about that. But in the new model, it won't have the same effect. A lot of people, if you spread your balances out now, let's say you have 3 credit cards, and they're all a $5,000 limit, but you've got one maxed out at $5,000 and the other 2 have a 0 balance. If you spread the balances out, you will increase your score. Okay?
Okay.
But that's entirely up to you. If you're out purchasing something that may be of value, if you've got a 0% interest rate for 6 months on that balance, you may not want to spread them out. So be prudent when you make those decisions.
Yes.
Authorized users still works with the credit bureaus. Many people think it doesn't. But if you're out shopping for a mortgage, the mortgage lender themselves may not let you utilize the authorized user. And an authorized user is, let's say that you're a parent and you want to establish some credit with your children. You may say, I'm going to give them my Shell credit card, and I make them an authorized user on that card. They will actually, you can make a phone call to your bank for a credit card or a gas card. They will send your child that card, and it will report. So all that history that you've had on that card automatically shows up on your children's credit report.
They get credit for your good payment history.
That's exactly right. It'll show up, and you could see a score boost or an immediate score show up, and they may have 2 years worth of payment history on there because they're an authorized user. So just be aware that that's out there.
Okay, good.
Credit bureaus can report a 30-day late if it's 1 day past due. So just keep in mind that typically a 30-day late is 30 days late from the day that you owe it. And it's up to the bureaus and the creditors to when they want to report it. So if I've had people call, I had a guy that had a consumer loan, and he had been purchasing, it was Best Buy's, been a great customer for 10 years, and he had a 30-day late and was trying to get a mortgage. I said, why don't you just call them and ask them if they'll take it off. They can see you've been a great customer. You've spent a lot of money with them. He did that, and the guy was happy to take it off, and they took it right off, and his score popped right back up where it was.
Wow. Ask and you shall receive, right?
Yeah, so sometimes you got a good payment history with the creditor. They're very kind and nice about just removing that 30-day late. No, this one is very interesting because this happens all the time. A lot of times people will say, well, go pay off that collection, the tax lien, and it will not increase. Doing that will not increase your score. Many people think it will because you're saying, well, I got this collection. Let's say it's a medical collection. We see those all the time. And let's say it's 2 years old. So it's on your credit report. Remember we talked about credit history. Well, that item now is dated 2 years old. So the date of last activity on that account, it has 2 years old. So it's hardly even affecting your score anymore. And let's say it's just a little $100 medical bill. So you say, okay, I'm going to go get a loan. The mortgage guy said, oh, go pay off that collection. We're going to have to pay it off anyway. And then you go pay that off, your credit score will go down because you've updated the date of last activity. Number one, it makes it look like a brand new collection because they're going to update it to today's date. And number two, you just re-engaged the 7-year reporting history on that collection. So it's going to stay on your report for another 7 years, or it can stay on your report for up to 7 years, that collection. So you've actually updated the account, and it's going to hit you like a brand new collection.
So instead of helping you, it has exactly the opposite effect.
That is correct.
Now that is a very interesting piece of news.
Yeah, what we recommend is pay it at the closing. If you're going to buy a house or something, just arrange it with the title company, if you can, to pay that at closing.
Oh, all right. So the person, you know, you're doing the right thing. You want to pay it, but you pay it at closing after you've been all the way through the credit gauntlet, and it doesn't hurt you.
Correct.
Okay, very interesting. We've got right here, we got another great giveaway, and one of the very common things that we hear about all the time, we've seen commercials, some creative commercials on TV, is identity fraud. And there is a great new service that will actually help you monitor your identity, your credit identity, your financial identity out in the market. And Jim, correct me if I'm wrong, isn't that a free service?
Yeah, it's a free service, and actually you could jump on board. And identity theft is the #1 white-collar crime in America today.
Yes.
So we're seeing more and more people with identity theft.
And so what this service will do, it's a free service. It will help you track your identity, see if it's been stolen, or give you other pertinent information about that. We'd like to share that with you. It's yours for free. Just give us a call at the number you see right at the bottom of the screen, and we'll pass that information right over to you. Okay. Now, you were talking earlier, Jim, about the types of accounts and how they can affect your credit score. And so you've got some information here that I think is very helpful. Why don't you run through that?
Yeah, just a few other tips for everybody on the call today. Secured and unsecured credit cards score the same. Some people think that they don't, or let's say you've had a bankruptcy and you had to go get a secured credit card, and it basically means that you're securing the line of credit. So if you get a $200 secured credit card, you probably sent that creditor or that bank $200, then they give you a credit card with a $200 limit. So
yes,
some people think those may score differently, and they don't.
I thought they scored less.
Yeah, and they actually don't. The ones that we tell people to get on to help reestablish credit, you can't even tell it's a secured card when you get it. There's nothing on the card that you can tell that this is any different from any other Visa or MasterCard.
Okay, very good. Helpful to know.
They score identical. So don't worry about that if you've been through a financial crisis and you're rebuilding your credit. Visa and MasterCards, department store cards, score the same. So if you're shopping in any of the retail outlets, the Best Buys, the Targets, any of those national chains, they all score the same whether you've got a Visa or whether you've got a MasterCard. So those score exactly the same.
Okay, good.
Joint accounts on credit cards are not a good idea unless you need it to get approved. Okay, and I hate to bring this up, but we've got divorce in our society right now is over 50% of the U.S. population.
It's a hard
and what
stat.
happens on a joint account after a divorce is, sadly enough, even though one party may say, I'm going to take care of that credit card as my responsibility, if you both have signed for it, even after divorce, the creditor can come after both of you legally because at that time you both signed the note that you are responsible for it. So let's say you get a divorce and the spouse is responsible for a $10,000 credit card as part of the settlement, but they go and file bankruptcy. Well, they're no longer going to get chased by the creditor. You are.
You are.
So
wow.
This is just a little tip. You don't even want to think about that probably when you just get married. But when you're buying a house or a car, it's a joint account, probably not a big idea. You may want to keep the credit card separate. I'm not saying for that reason in particular, but unless you're reestablishing credit, there really isn't any reason for you guys to sign up together on those accounts.
Very interesting. Yeah, when I was looking at that joint, I thought perhaps you meant, a parent and a child or something like that. But you're actually talking spouses, really anybody.
Yeah, exactly.
Okay. Talk to us about American Express here.
Yeah, American Express is a little bit different because a lot of people use American Express for business expenses and they pay it off every month. The American Express card is like a revolving account. And your limit on an American Express is going to be the most that you've ever spent on it. So when you get that American Express card and you spend $2,000, that will be your upper limit unless you ever spend more than that on American Express. The other thing you need to remember, let's say you're going to go out and purchase a home, and this is a business account, this American Express card, and let's say you typically charge $1,000 to $2,000 on it. You want to make sure that you pay that card down or off so it reports as a zero balance when you're going to go apply for that mortgage or that car loan. Because many people will wait till it comes in, they'll go apply for a mortgage, and lo and behold, there's your American Express card maxed out, and you don't even think about it at what cycle it's in when it's reporting on your bureau. So if you have control of those, very prudent to go ahead and pay those off a month or so before you go in and apply for one of those big mortgages or a car loan. Wow.
That's really helpful. I hadn't thought in terms specifically of American Express. You tend to think of it, well, it's just another credit card, but it really behaves differently. So that's very important to know. Now, you had spoken earlier back when we were talking about the components of a credit score and the things that make up the score. You reflected here on the scoring the effect by the age of the account. So you've got some great bullet points here. Why don't you run through those for us?
Okay, real quick. The older the account is, of course, the better because it's more history. The historical data was 10% of the scoring model. So, you know, if you've got something that's 5 years old, it's going to, you know, give you a little bump on your score. Don't close the old credit cards. It'll help your utilization ratio. Again, remember that upper limit of open credit that you have on your credit report. That's important. That's actually very, very big. It's 30% of your score. And we're recommending now, if you've got old credit cards, use them every 6 months. Go out and buy something and pay it off.
Yes.
That'll keep those open because the credit card companies now are telling us if you don't use them in those timelines, they're going to close them on you. So you may find yourself getting a letter that, hey, we've closed that card because of non-activity.
Okay.
Accounts that are closed and not used for 10 years may fall off your report. May or may not be a big deal. If you haven't used it for 10 years, you probably got other stuff you have used. So just so you know that. Authorized user still helps the scores, and it does not look at age or birthdays. And that FICO 08 may fix that.
Hey, let me stop you
crazy.
just for a second there. Can you give us in, like, 15, 20, maybe 30 seconds, explain FICO 08?
Yeah, FICO 08 is a new scoring model that they came out with, and we talked about the current scoring model has 10 scorecards in it. And the FICO 08 is going to take into some other considerations of authorized user and some things, some holes that they see, so they can get the scoring so it's maybe more accurate.
Okay.
So they come out with a new model, but no one's using it yet. So, but it's out there, just so people know that there may be a new model. And these algorithms, that's a very important point, can change at any time.
Yes.
FICO and the credit bureaus can change these algorithms as they see fit, and they do not tell anyone that. So the only time we see it is after looking at thousands and thousands of credit reports.
Okay. This is a biggie.
Yeah, student loans and deferment. The payment history is not used, and the utilization ratio is not calculated. So if you're going back to school because you've lost a job or something and you've got that student loan as long as you're in school, you can do what's called a deferment, and it will show up on your credit report that the loan repayment is deferred. And just so you know, when we see that, as far as the FICO scoring model is concerned, they won't use that in the utilization ratio or as a payment against you. So don't worry about the payment that's showing up there. It won't be counted.
Okay, very good. Now, let's talk about how delinquencies are reported on the credit reports. And here we've got a whole bunch of things that we've all seen or heard about. So let's talk about how they affect us.
Yeah, a lot of people ask this question. For the most part, what the law states is that negative information can stay on your credit report for up to 7 years.
Yes.
The only exception to that is the Chapter 7 and 13, and they can stay on there for up to 10 years. Now, some creditors pull them off after 7, so we just put a window in there of 7 to 10 years. So just so you guys know that.
I don't want to get ahead of you too far here, Jim, but what the law says is that they can stay on your report for up to 7 to 10 years. But what I think a lot of people misunderstand there is they believe that that's a requirement. So can you comment on that for us?
Yeah, that's one of the largest credit myths that we debunk all the time, and I think the credit bureaus have led everyone to believe that negative information has to stay on your credit report for 7 to 10 years.
Yeah.
And that is not true. What the law states is it's an upper limit, and that negative information can stay on your credit report for up to 7 to 10 years. Negative information doesn't even have to be reported on your report and can be removed by the creditor anytime they wish. Huge credit myth.
That's very, very big to know. Okay, so let's come back to your list here and run through here. You're starting to talk about tax liens.
Yeah, the other items on here, I just wanted to list them all because some people think they're different. They're almost all 7 years. You know, they can stay on there to negative information for up to 7 years. Inquiries typically show up on a credit report, and they only show it 2 years, and only the last 1 year actually counts against you. A lot of people don't know that. So they'll show you 2 years worth of inquiries, and let's say you've got 40 inquiries.
Yeah.
If you go back and look at the last 6 to 12 months, that's the only ones that's going to hit your score. So just so you know that.
That's very important to know. All right, so now in terms of inquiries, you talked before about hard inquiries and soft inquiries. So you've got some more information for us here. Why don't you run through this for us?
Yeah, the credit scoring models are being used now by insurance companies where they weren't in the past. So in the last 3 or 4 years, we're seeing the insurance companies pulling your credit scores now to set your rates on your car insurance and your homeowners. So those are called soft pulls, and those do not hurt your scores. So just be aware of that. Your personal inquiry, if you get online and you go to myfico.com or one of those places and you do happen to get your credit report off there, those are most of the time soft inquiries, and they're not hurting your scores. We call them a soft pull. So just be aware that you may see those on your credit report when you're looking at them. And if you're saying, oh my gosh, there's 2 pages of inquiries, you need to distinguish between a hard inquiry and a soft. So those aren't hurting your scores.
Okay, good.
We talked a little bit about the hard inquiries. The latest information that we have is around the first 10 hard inquiries on your score will hit your score about 2.89 points, and then there's an algorithm that used over that that kind of goes down a little bit. And of course, this is a changing thing, but this is the latest information that we have just by monitoring that information.
Okay, so if we throw this into, if we put this in English just for a minute, if your first 10 scores affect your credit at 2.89 apiece, just for the sake of conversation, say 3 points. So if you've got 10 hard inquiries, that could adversely affect your score by 30 points.
That is correct.
Okay. All right. This next one's a biggie because all the time while we were, when we're writing loans and we're checking credit and things like that, somebody will tell a horror story about they went to shop for a car and they didn't know the guy was going to send their credit out and it got pulled 12 times.
Yeah, that's exactly right. Shopping for a mortgage or an auto loan, the system is supposed to combine all those and count those as one inquiry.
Within 45 days.
Yeah, for 45 days since you did your first mortgage pull, if they're shopping your mortgage and they pulled it 5 times in that 45-day, they're going to count that as just one pull, and the same for an auto loan. It just counts as one pull.
Okay, but this is interesting. The next point you have here, though, is that while the autos would be one pull and the mortgage would be one pull, if you've got mortgages and autos, that would be at the very least considered 2 different pulls because those are separate types of inquiries, apparently.
Yeah, that is correct. Yep.
Okay, very, very good. All right, so let's talk about then a healthy credit mix. If we're looking at really building up our score, let's kind of bring all this stuff into focus. What can we do? What should we be aware of to create a good credit score and a healthy credit mix?
Yeah, here's kind of what we've seen over time in working with people's credit reports: 3 to 5 revolving accounts, and we don't want people to get too caught up on this. I'm more of a 2 to 3 person on the credit cards if you don't have any. I don't think you need more than that if you don't have a lot of credit. 1 or 2 auto loans are okay, so typical family, 1 to 2 car loans. 3 or more start to hit your scores a little bit because they're going to say, well, why do you have 3 or 4 or 5 automobile loans on there? Mm-hmm. 1 or 2 mortgages are okay. You will see your mortgage scores go down a little bit if you're an investor. So if you've got 3, 4, 5, 6 properties, you're going to see those start to hit your scores. Inquiries, we talked about that already. 3 to 5 per year is what the credit bureau would deem as normal. You went out and shopped for a car, you may have bought some furniture, or you applied for a credit card or something like that.
3 to 5 hard inquiries.
Yeah.
Yeah. Okay.
They consider that kind of normal. And remember, those drop off every 12 months, so those aren't a big deal, but that's how it affects your score. And then remember, the algorithms are a secret. So we just mentioned this in the last slide. They can change these at any time that they wish. They can change how much the scoring is hit by different negative items on a credit report. So the only way we see it is by looking at these reports, day after day, and thousands of reports.
See, that's very interesting. So the credit bureaus don't come out and go, okay, everybody, here's how we're going to figure out your credit score, or this is how we're going to calculate it. All that stuff is kept under lock and key, and it's only by looking at thousands of reports, Jim, kind of like you do, that you can sort of come back and interpolate what the rules are and how they're doing it and what behaviors they, how they score that.
Yeah, that's exactly right. So there's really no way to tell. You just need to do, what you feel is a healthy mix. And Ralph, like you said, the bottom line is just if you're making your payments on time and you're paying your balances down, you're probably going to have a healthy credit score.
Right. Okay, well, we certainly hope that you have found this to be a helpful discussion today. And I have to say, having been involved in credit-related businesses for some period of time, this is the most comprehensive and thought-provoking discussion on credit, and really with helpful information that I have not been aware of despite years in the business. And so I really want to thank our guest, Jim. What you put together here is fantastic. And I think you've got, we've had a series of little bonuses and freebie things that we have for you, Jim. I think you have one more for us, right?
Well, you know what, and this one is very, very important because we get a lot of people saying they may apply for credit for a mortgage or a car, and then all of a sudden their phone starts to ring at home.
Yes.
And they're going, how did they know I was shopping for a mortgage? Or how did they know I was looking for a car? And these creditors might start to call. And Ralph, the last tip that we've got, if they'd like to call that number on the screen right below where they're watching this video, is we've got a website they can go to, and they can actually opt out of the credit bureaus from reselling their information. How cool is that?
Really? Okay, now is there a charge for that?
It is entirely free.
Absolutely
and it will
free.
cut
Just
down
like,
on their junk mail. And
wow.
I'm telling you, it's probably one of the better things that they could do. But very important tip, it's for free, and I just want to thank you for having me on today.
You know, apart from all the great information, if you did nothing but gave us a ring down there at the number at the bottom and just collected all the free sites and resources and tips, I would certainly have to think this has been worth everybody's time. So listen, don't just let this stuff go in one ear and out the other, but take it and use it and apply it. If you have any questions, again, the number at the bottom of the screen, we can take you by the hand, walk you through it, make sure you have all the tools to help you get your credit healthy, get the score up, and have it work for you and help you out as best as possibly can. So that's what we have for you today. I want to thank all of you for joining us, and we hope to see you next time. Thanks a lot.